In this video, we're going to start our discussion of risk and return. Obviously, as you can see from the slide here, it's a two-part um, process, but we'll primarily talk about single assets and delve a little bit into portfolios in this particular set of videos. In the second part of risk and return, we'll talk more about the theory of how risk and return are related. So again, here we go. We want to figure out, how do we determine risk? Where does it fit into our analysis, if you will? Well, in the weighted average cost of capital, we understand that the costs of financing are certainly influenced by the riskiness of the company. So we have to figure out a way to quantify the riskiness of business. Certainly, business is uncertain at best. So we need to have some method of determining what we think risk is all about. Now, the challenge is, when we think about risk, we're thinking about what risk we currently have, but what we really want to know is, what risk will we have in the future? And of course, that just adds to the uncertainty. So, what are investment returns? I don't think we need to get into too much detail here, but obviously we can discuss investment returns in either dollar terms or percentage terms. They could either be historical, they could be prospective, as in predicted, but returns are obviously a major portion of understanding how we're going to make decisions. So, what is investment risk? And your text talks about the chance of earning less than what is expected, right? So, the greater the chance of a return below the expected, the greater the risk. Now, the challenge that I have with this definition is that it really only incorporates half of the risk measurement, if you will, or the potential outcomes. A better definition, and you'll see this in the notes here, is that it's the chance that the return or the outcome that you expected does not happen. And again, this implies a distance, right? How far away are the outcomes from what you expect or from the average? But it looks at it from a perspective from two sides. That is, the negative side, which is underperforming, and the positive side, which is overperforming, above and or below the expected or the average. So we're going to start thinking about perspective, right? We're going to predict what we think is going to happen in the future. So here we have this asset. We have some probabilities. That is, we have assessed and we have predicted the different types of economic events or cases that could happen in the future. And they use 4. You certainly could use 3. Using 2 sounds like too few. But again, we need to understand and predict what we think the probability of each one of these cases is. Now, the return is a calculation that we make, right? It's a prediction. If we buy this asset and the worst case thing happens, how will that affect the returns? Or what will the return, what expected do we think that the return will be? And of course, we do this for all the cases. So the first thing we need to do is to calculate the expected return, and it's really a product. It's a product of the probabilities multiplied by the returns. And of course, here you can see the calculation here as spread out. and obviously the answer is 6%. But we can do this much easier with Excel. And so if we go to Excel and look at this, here we see the 6%. Essentially what you do is you input the probabilities, and then you input the returns for that particular asset. So here we have two assets, asset A and asset B. So what you can see here is the expected return of A is 6%, and the expected return of B is 1.7%. So how do we do this? But before we go there, I just wanted to take a step and just to show you the Excel spreadsheet that will help you solve all these. And again, it's the thing that's on the slide there. But you add the probabilities. Again, probabilities should always be in decimal form, and percentages, or the returns, should always be in percent form. This just makes the math easier when we look at the outcomes. And then, of course, down below here, we have the formulas to calculate the expected return, and again, the other statistics that we're talking about. So we'll take a look at these worksheets as we go through some of the slides. So in this case, obviously, we see what? 6%, 1.7%. B is obviously a lower performing, lower return asset other than A. Now, essentially, one of our assumptions is that we have normal distributions. So how does a probability distribution work, right? So which one of these is riskier? Well, just from observation, you want to look at the dispersion, right? Dispersion is the number, or the word that we want to think about. Let me just kind of write that, dispersion. Right? Dispersion is how spread out are these. So if you look at this line, right, that is how dispersed, or how spread out, the blue asset is. But now let's look at the orange one. You can see that the dispersion is greater. So the more things are spread out, the more opportunity for something to happen that is not what you expect to happen, or is the average here. All right, so the more spread out, the greater the risk. So how do we mathematically measure risk? Risk, the total risk, or the standalone risk, is what's referred to as standard deviation. So that measures the overall dispersion of the possible outcomes. It's measuring this distance, if you will. So the formula, again, if you look at it, you take the rate of return and you subtract it from the expected return. That's what that R with the caret on top. Square that, multiply by the probabilities, and then, of course, you add that all up. That actually calculates variance, and standard deviation is the square root of variance. So let's look at our table here. And what we can see, what we can see here, the variance for A is 1.2, and the variance for B is 0.27. Now, it's obviously an important statistic. We rarely ever talk about it, though. What we talk about is the number we can use better that directly relates to that curve, right? The normal distribution curve is standard deviation. So standard deviation is 10.95% for A, and it's 5.16 for B. So all this is telling us is that B is less risky than A. Well, by how much? One of the statistics that your text doesn't talk a lot about is something called the coefficient of variance. And the coefficient, not variance, variation. The coefficient of variation is the expected return divided by standard deviation. This allows us to have a more, what we refer to as a relative measure of dispersion, right? So standard deviation measures the dispersion. Coefficient of variation measures the relative dispersion. And by converting to this relative context, if you will, we can now make comparisons. So we can see the 0.55, 0.33. It's not half as risky, but it's pretty darn close to half as risky, is asset B. And again, how do you find the product, right? Again, it's equals sum product. This is Excel. Then you put the probabilities, right? So again, if we go to this, right? So it says, what is the sum product? Oh, so sorry. Here's the sum product. And you can see that this is identified. Let me turn this off so I can highlight these things. So now if you look, the sum product is right here. So this is the sum product. So these are the probabilities, and then you do comma, and then you do the returns for that particular asset, but it's that return minus the expected return, right? So again, this gives us the variance. Then you take the square root of the variance to get standard deviation. So again, standard deviation is just the square root of variance. Investments with bigger standard deviations have more risk. They have more dispersion. So high risk, I want to kind of, this kind of drives me crazy in some of my classes, right? Where people talk about how bad risk is. Risk is not a bad thing. It's a thing that we need to recognize, and then we need to deal with it, right? So it doesn't mean you should reject the investment because it has high risk. You need to know the risk before investing, and if it has higher risk, you should expect a higher rate of return as compensation, right? So just because something is risky doesn't mean you reject it. It means you look at the return to try to make sure that the return meets your needs with respect to the level of risk. So again, analysts, if you think about switching gears now, we're going to talk about historical data. And we don't really have predictions, right? We don't know what's going to happen in the future. So we sometimes will measure the past. And if you look at data that's published anywhere, essentially what they say when they're measuring risk, return, etc., they're looking at historical data. Most of the time we use 48 to 60 months of monthly data. Sometimes you'll use weekly data, sometimes even some shorter period things for daily data. If you're thinking about looking at stock returns, though, we probably really want to look at monthly data. And again, 4 years to 5 years of data seems to give a pretty good picture of what the most recent past has been. So where do you go to get that data? Well, Yahoo Finance is one of the best places to go to get historical pricing data for stocks, for commodities like gold and silver. It's just it has a link to historical returns. So that is where we would go to right now to go and get this data fairly easily. Now, the people who are doing research, they have this data available in a variety of other sources that obviously you pay for, right? So this is free with Yahoo Finance. So that's where we'll ultimately go to find the actual prices assets. So to calculate standard deviation and variance for historical data, again, we add up all the returns. This is the mathematical average. You remember when you were like in the 4th and 5th grade. You add up all the numbers and divide it by how many numbers. That's the average. And again, this is kind of tedious, especially if we have a lot of time frames, like 60 months. To do that by hand is obviously fairly tedious. So we want to look at a spreadsheet that would help us do that. And we can do the spreadsheet. We can look at, again, it's called the historical data worksheet. And again, if we look at, again, I want you to see this. So let me make this so you can see. Down below at the bottom of the spreadsheet, right, we were just at the standalone risk worksheet. And we want to go now to historical data. So if you click down, they're in alphabetical order. So you go to historical data, and here are returns. Now you can use this spreadsheet a couple of ways. You can get prices, enter the prices here, and it calculates the returns over here. Then what you would do is go to the other thing over here, and you want to point to the oops, I'm sorry, it's over here. Over here, you want to point equals, and then you would go over here and find the return, right, and hit the return button. That would give you the return for that period. The other way you can do that is just to input here or copy and paste from some other source the actual returns that you have. But as you see here, we have a space for asset A, B, and we have a space for the market returns. Down below, again, this obviously there's a lot of information here, right? But we have the mean, that's the average, right? We have the standard deviation, coefficient of variation. We'll talk about some of this other stuff as we go through these videos, but that's how you would calculate, again, these basic statistics on using Excel. So let's kind of go back here. Again, here we have our formulas. That's not a big issue anymore. So now, what is Blandy's? Blandy is asset A. What's their standalone risk? So if you look at the data from up above, right, here is asset A is Blandy. 6.4% is their return. 9.2 is the return for what's called Gormash. I'm not sure what that is. Here's the standard deviation, 25.1, 38.5. So that is the standard deviation or the total risk of the individual assets. In addition, here we also see coefficient of variation. Again, we can see that in this case, Blandy, relatively speaking, is less risky than the other asset that we were talking about. So here are the returns for the market, Blandy, and Gourmand, and here are the standard deviations. So what can we do with this information? Returns are normally distributed. The average standard deviation for a company is for Blandy, here is 25.2%, and the expected return is 6.4%. So what does this mean relatively speaking, right? If you kind of think about this graph up above, let me go back to that real quick, right? This dispersion, right? How do we convert that data that we just had to this particular graph? We want to measure the distance, if you will. And how we do that, and how we measure that, is through something called confidence intervals. So here are the confidence intervals, the upper and lower, and this is for the 95% confidence. So we are certain that the actual outcome in the future will be, there's a 95% chance that it's between 55% and negative 42%. So what does that mean? If you add those two together, that's a range of roughly 97%. Let's look at the stock market. The range, right, that's 78%. So the range, the dispersion for the stock market is much lower than what the range is for asset A here, right? So we're looking for this distance. So again, if we come back here, 16% of the time, approximately, the return, it will be less than 18.8% or greater than 32.6%. So again, one standard deviation is 34%. 34 plus 34 is 68. Subtract that from 100, that's 32%. So what that means is there's 32% of the time we will be plus or minus one standard deviation or more. The point here is stocks are pretty risky. Well, we know that stocks are risky. This just quantifies that. So what do we have for asset B? Again, 16% of the time, right, it will be greater than 84%. Excuse me, this is 95%. And this is 16% of the time, it will be less than 66%. Now, we would really like to find assets that have very low probabilities of negative returns, right? I mean, you don't want to lose money. So again, what we've covered so far in this video is the idea that we can measure risk, whether it be prediction or whether it be historical. Now, the one thing, again, I always want to add about historical, if I can, just to keep reminding you, is just because you're measuring the past, that doesn't mean the past is going to happen in the future, right? There's no direct link. I mean, it seems like it happens that way a lot, but history does not necessarily repeat itself. So that's the end of this video, and I'll see you the next time.